Hi everyone, today I'm going to be talking about 5 UK stocks that I've just bought on Monday this week, and I kind of bought these stocks because I feel like the UK stock market is still quite at a decent value compared to something like the US stock market right now. Also, I had the kind of cash from the profit, the 8% profit from Wynn Resorts, the 50% profit from iRobot, and it was a good opportunity to go buy some more stocks and make some more money, because I feel like most of these companies I'm going to talk about today, a lot of them pay a decent dividend, or will probably pay a decent dividend at some point again when everything's resolved. And also, I believe the stock prices could probably make 50 to 100% over the next few years as well. So I feel like there's some good opportunity here. I've also kept quite a bit of cash still on the sideline, just in case some of these stocks do go lower. And as well as that, if the US stock market does pull back, I've left a lot of cash to go buy some stocks in the US stock market in case of a pullback. But I'll go through these 5 stocks. I'll kind of talk you through which ones I bought more of, which I bought less of, and also I'll cover some reasons why I bought these stocks, but I've covered them before on the channel, so I'll probably have a bit more detail on some of them videos if you do want some more detail into these stocks. But we'll have a look into these, and always guys, if you can always smash that like button, it's absolutely amazing. And we'll get onto these 5 stocks. So number 1 is Greggs, the bakers, the home of the sausage roll. We are going to be buying some more Greggs or have bought some more Greggs, and I was down 10% on my position, which was the smallest position, but this is the one that I've bought most of this week, as well as position number 2 actually. So I'll show you that one in a second. But Greggs, I bought a lot of shares of. Now, the reason why I bought Greggs is because I feel like this company is in a good place to do well once it opens up. There was rumours it was going to open up, but it was slightly worried about some of the demand and if it was going to have too much demand in the shops and how does it do social distancing. So it has delayed like the opening, but I feel like Greggs, as soon as it opens up, it's one of those companies that's going to really benefit. We've seen what's happened with KFC. They had like queues like so far wide. It basically put like Manchester to a standstill. But Greggs will do fine once it opens up, and it's a company that I feel like will probably open up sometime soon. It's made good investments. It's had its own food supply chain now, which means it's able to increase its profit margins and make more profit. It's also benefited from a vegetarian menu as well, which it should do really well from. The share price itself is massively undervalued right now. I think it's down at £15, and like I say, I think Simple Wall Street say it should be £26, but I see this one probably being £30 a share within 2 years, so I like it from that way. When we look at the growth is going to do fantastic. As well as the revenue growth, we're going to see some decent EPS growth as well. Decent EPS growth will probably lead to us having a better dividend as well, which is always a nice thing to get, isn't it? The past growth has been absolutely amazing on this company. And when we look at the balance sheet, it's a company that has 0 debt on its balance sheet. You know I like my nice balance sheets, and especially in a time like this, a company with no debt on its balance sheet at a massive discount is a big screaming buy to me. And you know what? I'm talking about this stock right now and I'm thinking, maybe I should have actually gone and buy some more. But yeah, no debt on the balance sheet. It holds 91 million in cash. It was paying a 2.31% dividend yield, which isn't too bad. And when we look inside the company, like insider trading, we've got the financial director actually on the 26th bought a few shares. And also the CEO, Roger Whiteside, he actually on the same date, he as well bought £178,000 worth of shares as well, which is a fantastic sign. So the insiders on this one really stands out to me, and like I say, I really like this company, and now that I'm talking about it, I actually might go buy some more. So I really like Greggs, and it's a company that offers growth, a dividend, and a fantastic balance sheet. So it's everything that I can ask for in a company. It does trade at a little bit of a premium of a P of 18, but like I say, I think this is a solid buy. Number 2, I bought as many shares as Greggs as I did as Hollywood Bowl. These were the 2 biggest investments I made, but Hollywood Bowl basically was the biggest 10-pin bowling centre in the UK. It also now offers arcades and also has bars. It's also looking to expand into having some mini golf centres. As well as that, it's also looking at opening up more venues, which will help the EPS and revenue do really well going forward. It also has 0 unprofitable stores or venues in the UK, which is absolutely fantastic. Every venue makes profit in the UK. And as well as that, the management do a great selection of the locations. So Hollywood Bowl normally select their locations somewhere that's in like a retail estate park where there's kind of like a cinema, a few restaurants, you know, like in Nando's, Frankie Benny's, that kind of thing. So it's kind of like one of those where you go, right, we'll go bowling and then we'll go get some food, or we might go to the cinema and then we'll go to the arcade in Hollywood Bowl. So they all tie it in really nicely. So they're really great with the management side of it. According to Simply Wall Street, it is 46% undervalued, and I tend to agree. Like, for me, this is a company that I really like. I mean, it's good. I think there might be an opportunity to buy this one cheaper in the long term with everything that's going on and with it not being able to operate. But like I say, I see myself holding this one for 2 to 3 years, and I aim to make about 100%, 100 to 200% on this one. I really like this one. Growth will kind of do really well, same as earnings, because of, you know, how well they manage the company with its new venues that open up in the next few years. It'll do fantastic. Past performance as well, it's kind of got the evidence to show that it does really well in the past evidence. Debt wise, there is a little bit more debt coming on this balance sheet. I don't believe Simply Wall Street have updated it correctly yet, but there's a little bit more debt than this, I think, on the balance sheet. But even so, it's not a bad balance sheet overall. It says here that the cash is 24 million and the debt's 26 million. I think the cash has gone down slightly since then, but overall it's not a little bad balance sheet. It was paying a dividend yield of about 6-7%. Obviously it's had to cut its dividend now, but you know, when eventually it comes back, I'm sure it won't take it too long for it to start buying some of these or paying its dividend again. When we look at the insiders, this really kind of pushed me over the line. There was just so many insiders buying now at these sort of prices. Everyone in any kind of positions buying it. The CEO's kind of buying shares, the CTO, the lead director, they're all buying shares. The CFO, head of human resources, chief operating officer. There's just loads of shares being bought at the moment, which is absolutely amazing. So it's good to see that they're all kind of thinking, let's all buy our shares at these sort of prices. So I love that as well from Hollywood Bowl. Next up is Barrett Developments, a house builder, and I believe that mostly a lot of this is still operating. I believe they're still building a lot of houses. I believe there's not many viewings because of social distancing, but I believe a lot of the houses are still getting built, which is still okay. But I like the house building sector because just generally in the UK we're just so far behind the amount of houses that we need. That I believe a lot of house builders are safe. I like this one. I like Red Row. I like Taylor Wimpey. I think they're all three great house builder stocks, but for me, Barrett Developments just kind of has the edge in this kind of sector. It's a stock that I hold, but I believe that it's still at a decent discount, and according to Simply Wall Street, it's still 48% undervalued. And I would tend to agree that me holding this stock, I would like to get about 100% return on this stock, to be honest with you. So I bought this one a little bit heavy, not as much as Hollywood Bowl and Greg's, but I did buy a little bit more into Barrett Developments. Revenue and EPS wise, it's pretty much revenue's going to decline slightly and EPS is kind of just slightly going to stay flatline, maybe slightly go up, but I don't think that's quite correct. I believe that what will happen as house prices go up and the demand from houses still continues, and I think there's kind of that worry that the housing sector will slow down slightly, but if you look at Barrett's past developments, you can see they've just had a steady increase in revenue and EPS, and I think that will just continue because house prices just naturally go up. Even with what's going on right now, I would see them kind of recover pretty quick. Also, probably the thing that pushed me across the line with Barrett Developments is the balance sheet. It's one of the best house builder balance sheets out there. 626 million in cash. The debt is 20 million, so it's got 3 times the cash than debt. Absolutely fantastic balance sheet. It did pay a dividend, a very high dividend yield of 7% before it actually had to cut it. But like I say, I do kind of see this one paying its dividend probably next year again. And at these sort of prices, it should be paying a dividend of about a 5% yield. So it'll be a really healthy dividend to be picking up as well. The only negative I do have with this sort of company is that I haven't seen many people actually buying shares on the inside right now. I like to see a few more of them buying their own shares back, but none of them are selling, so that's a positive. But I do like Barrett Developments. It is my favourite house builder on the stock market. Next up is JD Sports, and if you've been watching the channel, you know I sold out my shares in boohoo.com for an 85% profit, and I kind of wanted to get another growth stock, and I decided to go with JD.com because this one kind of looks undervalued and is kind of in the same industry, but at the same time it owns a lot of names. Obviously it's a lot more high street based, but also it does have JD gyms as well, so it is a very well diversified company. It does trade at a little bit of a high P, and according to Simply Wall Street it is overvalued, but for me, because it's a growth stock, Simply Wall Street doesn't really like growth stocks. It does tend to say they're overvalued. But for me, I would say that this stock, I would like to get another somewhere between 50 to 100% return on this one, because when you look at the forecast for the revenue growth and the EPS growth, it looks absolutely fantastic. And when you look at the past performance as well, it has lived up to expectations. So I do really like this company. Balance sheet wise, it's a company with another great balance sheet. It has 346 million in cash, 228 million in debt. So its cash definitely covers its debt. It does pay a slight dividend of 0.31%, but going forward, it is expected to really increase this dividend because the payout rate is only 6%. So it can definitely afford to be paying the dividend a little bit more going forward. And my last one is 888 Casino. This is the smallest position that I had, but I did buy a little bit more into this stock. Basically because this stock will do all right. It's not going to be affected because it mostly relies on its kind of gambling side of it rather than sports gambling, compared to your normal kind of gambling stocks that kind of rely on like football and other sports like that. 88 Casino is more kind of blackjack, Texas Hold'em, poker. So it should still do all right, and with its international growth plans, I really think this one could do fantastic. Now the valuation on this one is that it's 29% undervalued. I would say that it's a little bit more undervalued than this. Once again, I would be looking somewhere between a 50 to 100% return on this company right now, in my kind of opinion. Growth wise, EPS is going to steadily grow to about 10%. Revenue wise, that's probably going to go up another 10% as well. So the EPS and revenue side of it looks great, and historically the revenue has done pretty good in 88 Casino. EPS not too bad, it's just spent a lot of money in expansion. And balance sheet wise, it's got such a good balance sheet because of it having not many overheads. When you look at a lot of gambling stocks, a lot of their overheads can be quite expensive, and that leads to not great balance sheets. But 88 Casino, their balance sheet is pretty good. They've got 100 million in cash, they've only got 17 million in debt, so they've got a really covered balance sheet here. And also it pays a 3.37% dividend yield and a 53% dividend rate, which I don't think it has cancelled just yet. So that's a nice little pickup that I think I can make. I would hopefully try and get at least a 70% return from this one. So guys, those are the 5 UK stocks that I bought this week. I've bought these ones because I believe there's quite a few upside on this one, especially the kind of Hollywood Bowl and also Greggs. I believe I'm going to make probably about 100% plus on them. The other ones, kind of a little bit less. I think Barrett Developments, that could be another good one. That could probably get 100%, and like I said, the other two, I'm aiming for more of a 70 to 80% return on that one, and I kind of see them kind of getting there within 2 to 3 years, which would be a nice little hold really. And like I say, I am holding a bit more cash in case there is a pullback in the US stock market, and also some of these still might go down from here, so I am holding a bit more cash if to buy them a little bit more. With regards to Dark Group, I know some of you guys asked me about Dark Group. I am not buying that one just yet because I feel like there's no rush. There's not going to be any holidays anytime soon. So I'm kind of like waiting on that one, but I probably will buy a little bit of Dark Group in the future. But I thought I'd update you on that one as well, guys. And as always, I hope you enjoyed the video. I hope you enjoyed me sharing this information with you about these UK stocks that I bought. Comment any UK stocks that you guys bought. That'd be absolutely amazing. Like the video, subscribe if you haven't, and I'll see you in the next one.